What if I told you a company worth $60 billion could vanish in 60 days? Enron Corporation, once hailed as the paragon of innovation, collapsed into oblivion, leaving behind a trail of devastation. Founded in 1985 by Kenneth Lay, Enron was born from the merger of Houston Natural Gas and InterNorth. This merger was orchestrated to create a formidable entity in the booming energy sector, with Lay at the helm, guiding the company with a vision of transforming the energy landscape. It started as a legitimate energy company, thriving on natural gas, and quickly grew to become one of the most powerful players in the industry. Fast forward to the 1990s, and Enron transformed under CEO Jeffrey Skilling. Skilling's leadership marked a shift to aggressive trading and speculative practices. He introduced the asset-light strategy, focusing on trading energy contracts rather than owning physical assets. This approach led to the creation of Enron Online, the first web-based commodities trading platform, which revolutionized how energy was traded. Enron employed complex accounting techniques such as mark-to-market accounting to hide debt and inflate profits. This allowed them to record projected profits on future contracts as current income, creating an illusion of financial health. By 2001, Enron was celebrated as one of America's most innovative companies, with revenues exceeding $100 billion. The company was named America's most innovative company by Fortune magazine for 6 consecutive years. But this success was a mirage. As Enron's stock peaked at $90.75 per share in August 2000, the cracks were already visible. The company had created special purpose entities, SPEs, like Chuco and LJM to manipulate financial statements, hiding debt and inflating profits. These partnerships, managed by CFO Andrew Fastow, were used to keep liabilities off Enron's balance sheet, creating an illusion of prosperity and stability. By October 2001, the facade crumbled. Enron announced a staggering $618 million loss and a $1.2 billion reduction in shareholder equity. This revelation sent shockwaves through the financial world, sparking panic among investors and employees alike. The news was devastating for those who had placed their trust in the company. As the truth about Enron's financial practices emerged, confidence in the company's leadership and future evaporated. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, marking the largest in U.S. history at the time. The once mighty corporation, which had employed over 20,000 people, was now a shell of its former self. The bankruptcy filing was a sobering moment, not just for Enron's employees and shareholders, but for the entire corporate world. The fallout was catastrophic. Arthur Andersen, Enron's auditing firm, which had been complicit in the fraud, dissolved, leading to 85,000 job losses worldwide. The firm's reputation was irreparably damaged, and it became a cautionary example of the dangers of compromising ethical standards for profit. Key figures like Kenneth Lay, Jeffrey Skilling, and CFO Andrew Fastow faced criminal charges. Fastow's intricate schemes to hide debt and inflate profits came to light, revealing the depth of Enron's deceit. Fastow eventually pleaded guilty to charges of conspiracy, fraud, and money laundering, agreeing to a 10-year prison sentence in exchange for cooperating with prosecutors. Skilling was convicted on multiple counts of fraud, insider trading, and conspiracy, ultimately receiving a 24-year prison sentence, though it was later reduced. Kenneth Lay, who was convicted of fraud and conspiracy, died of a heart attack before he could be sentenced, sparking mixed emotions among those affected by the scandal. Enron's collapse resulted in estimated losses of $74 billion. Thousands of employees lost their jobs and life savings, as the company had encouraged them to invest heavily in Enron stock for their retirement plans. The stock plummeted from $90.75 to 26 cents in mere months, wiping out the financial security and dreams of many hardworking individuals. The emotional toll on employees and investors was profound as they grappled with the betrayal and loss of their livelihoods. The scandal triggered significant regulatory changes, notably the Sarbanes-Oxley Act, aiming to improve corporate governance. This landmark legislation, passed in 2002, introduced stringent reforms to enhance financial transparency, protect investors from fraudulent accounting activities, and hold corporate executives accountable for their actions. The act mandated stricter internal controls, increased penalties for fraudulent activities, and established the Public Company Accounting Oversight Board, PCAOB, to oversee the audits of public companies. The root cause of the Enron scandal was a corporate culture that prioritized profit over ethics. Executives engaged in deceitful practices, driven by personal wealth and market dominance. The relentless pursuit of higher stock prices and increased market share led to a toxic environment where unethical behavior was not just tolerated, but rewarded. Lack of oversight, coupled with auditor complicity, created fertile ground for fraud. Enron's board of directors and audit committee failed to question the company's questionable accounting practices, allowing the fraud to continue unchecked. Enron's story is not just corporate fraud, it's a human tragedy. Dreams were dismantled, financial security destroyed, leaving an indelible mark on corporate America. The scandal serves as a powerful reminder of the consequences of unchecked greed and the importance of ethical business practices. It highlights the need for corporate leaders to prioritize transparency, accountability, and the well-being of employees and investors over short-term gains. The Enron scandal serves as a cautionary tale about unchecked greed and the necessity of ethical business practices. Its lessons continue to shape corporate governance and financial regulations today. The collapse of Enron forced companies around the world to reevaluate their own practices, leading to a renewed focus on ethical standards and corporate responsibility. The legacy of Enron is a testament to the enduring impact of corporate malfeasance and the ongoing struggle to balance profit with integrity in the business